Hi, professional. I hope you are doing great. The topic of today's discussion is to know the difference between the insurance and hedging, because these two are, although these two concepts are used to mitigate, to manage, to transfer, to as a part of the overall risk management strategy of the company. However, these are entirely different, and for the from the accounting perspective, the insurance contracts are dealt in with IFRS 17, which deals with the accounting of the insurance. However, on the other side, the hedging accounting is in the IFRS 9, which explains. So accounting is entirely different. So we must find a basic difference of what is the difference, because the accounting is entirely different. So first of all, we will understand the insurance contracts as per IFRS 17, and then we will be able to get a clear difference of these two terms. So in insurance, there are basically two parties. One is the issuer of the policy. The other is the policy holder. So this is basically the insurance company, you can say, and this is the policy holder, an individual or company that has obtained the insurance policy. So these two parties are there. So the basic theme of insurance is that the issuer of the policy agrees to the policy holder that, okay, I am issuing this policy to you, that if a future uncertain event will occur, I will compensate you for any adverse effect you may have faced due to that uncertain future event. Okay, I will again repeat. So there are basically four things in the insurance contract. Number one thing is that there is a significant insurance risk. Number one, the significant insurance risk. So this is the point where we can differentiate the things. I will explain the other 3 points as well, but the first thing I will explain is what is the insurance risk. So insurance risk is any risk other than financial risk. You get my point? Insurance risk is any risk other than the financial risk, and financial risk is the risk of you due to possible change in variables like interest rates in the markets, inflations, and currency variations. So these all things are possibly the risk of possible change in the variables. So this is all financial risk. So all the financial risks are excluded from the insurance, meaning thereby the insurance only deals with the insurance risk, and the insurance risk is what? All the risk other than financial risk. So all the financial risks will be dealt in within IFRS 9 for the hedging and speculation things. So insurance contract is purely insurance risk, which is risk other than financial risk. So there is a significant insurance risk there. Then there is a compensation to the policy holders. That if, and the third thing is the specific uncertain future event. Like if in the life insurance, the insurance company agrees that so the death is certain, but the timing of death is uncertain. So this means that the life insurance policy is also an uncertain future event. Although it is known that death will be happening to every thing. However, the timing is uncertain. So this makes them be uncertain. So every uncertain future event, the insured uncertain future event, in case of insured uncertain future event, the policy holder will compensate to the policy holders for the significant or adverse effect if it has. Like we have the motor insurance. If I talk about the general insurance company, they have accident insurance, they have motor insurance, marine insurance, health insurance. So every these things, if the policyholder suffers a significant, adverse loss, then the company will be obliged to pay that insurance money. So this means that insurance is entirely dealt with the non-financial risk. So that's why this is the IFRS 17 is written for the accounting treatment. On the other side, including the financial risk, there is a policy which is called hedging, and in the hedging, there is no such transfer of risk. In the insurance, we study that okay, the policyholder transfers its risk to the insurance company, and the insurance company reinsures and retransfers it to another party. So there is a transfer of the risk. However, in the hedging, there is no such transfer of risk. There is a financial risk for which basically the risk definition is that the risk is the chance of occurrence. It can be positive as well and negative as well. However, commonly it is perceived as negative. So in the this hedging, there is no transfer of risk. There is just this is just a measure that we take in order to avoid our fluctuations, too much fluctuations, which can be either both positive side as well as negative side. So in this, we do not transfer the risk; we just mitigate our risk. So if we assume that dollar will be like 300 per Pakistani rupee, we anticipate dollar can either be 270, 250, or it can be 350 as well. So both sides this is possible. However, as we are afraid that okay, dollar may cross 300, so we involve ourselves into hedging techniques. So this means that we are not transferring any risk; we are just covering our risk. We are just covering our risk. So this is the hedging. For the detailed lectures on the hedging and insurance treatments, please follow my page. Thank you so much, and that's it for today.